Hello everybody, my name is Mark. Welcome to another video, and in this video it's time to get out of my trade and take my profit. So here's what happened back on November the 25th. That is a week ago. I bought to open two calls on Uber. Strike price $50, expires in January 2023. That is 2 years, 26 months from now. Spent $1,440 a pop. Total cost $2,881 and some change. Then I sold to open one Uber call, $52 strike price, took in $73, expires December 4th. That is 2 days from now. And today, being December the 2nd, it was time to take my profit. And my total profit, I spent $2,800, I collected $32.48, and I bought to close this 52 short for 148.66. I put all this in my calculator, and here's my total profit: $290.95. This 32.48 is the money I made on the longs, and then the money that I lost on the shorts would be right here, 148, and also the 72. It would be 148 minus 72. Total profit $290.95, and that's a pretty good return for a $2,800 risk. That is a 10% profit on the trade in about a week. So where can you do that? Buying stocks, you can't. Well, maybe you could, but you'd have to get super lucky. But with stock options, this happens every day. Now, when and why to take a profit? I think this is super important to understand. Super important. So take a look at this $50 call that I bought. Not that one, but this one right here. Okay, I spent $1,440 for a $50 call. So 50 plus $1,440 gives me a $64.40 break-even price. One of the big granddaddy differences between stock options and stock is that when you buy a stock, you have a dollar cost average. When you buy calls, you have break-even prices. Call options don't have dollar cost averages. Stocks don't have break-even prices. You have to understand that if you are going to trade spreads, because let's say that I decide to get greedy and I hang in there to try to make more money on Delta, and then what happens if my $52 short gets exercised? I'll tell you what happens, okay? My broker, Ameritrade, ends up buying 100 shares of Uber at $50. They would exercise my long call to come up with 100 shares, and then those 100 shares get sold for $52, giving me a $200 profit. But look at how much money I spent for the call, $1,440. So I end up taking a $1,200 loss. That's the difference between a covered call and doing a spread. If I were to sold covered calls on this, then no big deal. I could just hold this and roll it up and roll it up. But this is a spread. I don't own 100 shares. I bought the call, and you have to understand that. You have to understand the difference between a break-even price and a dollar cost average, because no way in heckety heck would I want to buy Uber at 50 and then sell Uber at 52, make a $200 profit, and then watch my call option get removed and the $1,400 that I spent goes poof. Okay, so that's why I decided to take a profit and not get greedy and not try to just simply roll it up. Okay, I think that's just some very stupid way. That's a very stupid way to trade your options. Okay, yeah, it is possible that the option may not get called away, but that is not a risk that I choose to take. So the best thing for me to do is to get out of this spread. No more diagonal spread for me. Now my money's free and clear, and now I got a new spread. As of today, I sold a vertical spread. Now I sold three $46 puts, and these expire in about a month, January 15th, 2020. And I did 3 contracts, took in $312.99, and then I bought 44s, and I spent $208. Now my total risk on that is 46 minus 44 times 3 is 600 minus the premium, so about $500 risk. That is about 2% of my cash balance, but just heads up FYI, I did totally F this up, and I wanted to do a $1 spread, but I was feeling so pumped at what Uber's doing. If you look at the move that it made, and let's talk about this move for a second. So this is a 5-day chart here, and I want you to pay attention to the crossover from yesterday to today. So that's the crossover, okay? On this side of the line is yesterday. On this side of the line is today. You don't see any gap. You don't see like the stock closes here and then it opens there. Nope. What it does is it closes there and it makes a totally smooth move. So this is a very smooth upward trend. And so that gives me a lot of confidence in the longer time frame, which is, okay, so this website is glitching on me. So let me close out of this real quick and let me reopen back up into Uber so that I can pull up the 3-month chart. Apologize for that. That's what you get when you use free website services. Now let's pull up the 3-month chart. So anyways, let's go back to my transactions and let me rehash. So I sold the $46 strike price put vertical spread. I bought the 44s. That means I don't want Uber to go below $46 a share. And I showed you the 5-day move here. Let's go back to the 5-day move. Again, here's the 5-day move, a totally smooth move, which gives me a lot of confidence in this new trend, this uptrend that's happening here. And now let's go back to the 3-month chart. So again, I sold the $46 put. This is the $46 level right there. Oops, I didn't mean to do that. Here we go. So right there. So I am literally selling puts at the very bottom support of the trend. And I'm going out a month. And when this trend first started, that was back on November the 9th. That's almost a month ago. And if we look at the stock, there's no earnings coming up. There isn't any expected news that's going to come out that's going to make it go reversing. And the next earnings date is on, where is it at? February the 4th. So it's totally safe for me to do this vertical spread. But that's a whole nother video with a whole nother question. But in this video, the one takeaway that I want you to get, when and why to take a profit totally depends upon the particular spread and the options are selling. But for me, because I had sold the $52 short, I'm not going to take the risk of, and let me go back 1 month so we can get the opening transaction here. I'm not going to risk this $1,400 to make a $200 profit and then watch this money go poof. So the one takeaway is you have to understand the difference between a spread and a stock. If this was a covered call, no big deal, but it's not. It's a spread. And because it's a spread, it has a break-even price of $64. And so obviously I am not going to sell Uber at $52 a share when my break-even is $64 a share. So that is a little bit of when and why to take a profit. I'm sure there's probably thousands of reasons when and why to take a profit, but I think my reason is as good as any. I'm not going to risk $1,200 to make a little bit more money. Maybe if I'm lucky, a couple more $100 in the next couple days on a delta. So that's it for this video. As always, if you have any questions or comments, feel free to leave a comment or feedback. Hit the like button, whatever you choose to do to show some love and support. Thank you for watching. I will see you in the next video. Have a good day and ciao.